So, good afternoon, everybody, and welcome to the third in the Urban Living series of webinars. These webinars are put together as a precursor to an event that we are launching in London, which is taking place in November at Tobacco Dock, called the Urban Living Festival. It's a new event which looks at various hospitality and real estate asset classes, how they're converging, and how the future might look. Obviously, our agenda for that event and for these webinars is something of a movable feast, thanks to what's been happening over the last few months. And we're very keen to have a big investor focus at the event. And today's webinar is to look at investor sentiment across hospitality and real estate, to look to the future, but also to see how the pandemic has affected investor sentiment. A bit of housekeeping here, some of our guidelines. So everyone who is not one of the panelists will be muted, but you can communicate with us using the chat function. So if you have a question for any of our speakers, please do enter it into the chat and we can deal with those towards the end of the session when we're going to have some Q&A. Next slide, please, Justin. Okay, my name is George Sell. I'm the Editor-in-Chief of International Hospitality Media. We are a B2B online publisher and an events organizer, all in the hospitality sector. So we publish service department news, boutique hotel news, and short-term rentals. We've got a fantastic and very strong panel today. These guys have invested in a wide range of hospitality and real estate asset classes. And I'd just like you all to introduce yourselves quickly, if you may, starting with you, Mylan, if you could, please.
Of course. Hi, everyone. Very happy to be here with you today. My name is Mylan de Marcilly, and I am a director in investments at KKR. In charge of real estate investments in France for the group and of hospitality investments in Europe. When it comes to hospitality, which is the focus of the session today, we have been investing in the space for quite a few years through our private equity funds and real estate funds. And on the real estate side, we have a few positions today, including some resorts in the Balearic, Ibiza and Mallorca, a hotel in Paris that we are refurbishing right now, and a hostel venture that we're expanding across Europe.
Okay, thanks, Mylan. Michael, would you like to go next?
Sure. Hello, everybody. I'm Michael Abel. I'm a partner at TPG. TPG is a global investment firm. We invest across all traditional asset classes, but also very active in alternative space. So we have investments in living.
Too much sugar. Too much sugar.
Can you hear me?
Based on this.
Yes, somebody is coming across who isn't on mute, who should be, but I can't see who it is. Sorry, carry on, Michael.
So we have also investments, obviously in the context of living. We own one of the leading PRS platforms in Spain. We own Hostels, which is the largest hostel platform in Europe. We have investments in student housing and many other things. So it's a bit of a mix. We have generally been, I would say, focused, as I said, on kind of platforms. That's how we differentiate ourselves from most traditional investors. We can also buy individual assets, but generally we like the platform approach.
Thanks, Michael. Lissa, over to you.
Yes. So I'm founder of Berkeley Capital Group. We are a full cycle investment management firm focused on hospitality in the UK and Europe. What we do is we partner with private equity firms, institutions, and family offices and provide a turnkey investment, i.e. we source, underwrite, develop, and asset manage. So currently we are developing a hotel in the UK that will be opening in Q1. We're also underwriting several development deals across Europe, and we're also looking to acquire with one of our PE partners several hotels, existing hotels that may be needing to sell at some point later this year.
Thanks, Lissa. Christian.
Hi, everyone. So I'm a director at DCZ Investors. So we're a pan-European real estate investment management business. Much like sort of TPG, we're across all the traditional real estate sectors. Over the last 3 or 4 years, had a big push into bed sectors. So we've done a lot in the build to rent and residential space. And most recently, in October last year, we launched a new fund in partnership with The Collective, who are a co-living operator. And we're targeting building a £1 billion London-only co-living fund with The Collective. So we're spades in the ground on a couple of assets at the moment. But yeah, we have got investments across build-to-rent, hotels, service departments, and co-living now.
Thanks, Christian. And last but not least, Florian.
Yes, co-founder and a managing partner of Resonance Partners. We're a real estate and real estate technology investor, mainly focused on the US. Dominic, my other partner, and myself, we were previously partners at Global Founders Capital. We have been very much focused on multifamily in the US, as well as industrial, but now selectively looking at hospitality and other living strategies where I have a background in as well as student housing.
Great, thank you. So before we start on the discussion, I just wanted to have a look at a slide with a bit of context. Some of the background things that are happening that may affect investor sentiment to some of the things we'll be talking about. So hotels have obviously been hit very hard by the pandemic. And as you can see, the Baird STR index is down a lot for the year to date. On the student housing side, in late May, Cambridge University became the first to say it won't be offering face-to-face lectures for the whole of the next academic year, which obviously has serious implications for student housing in the short to medium term. The service department sector has performed very well comparatively, but there hasn't been a great deal of M&A activity in the sector, and it'd be good to talk about whether we think that might be set to change. Justin, if you could move on to the next slide, please. The retirement living sector is an interesting one. There was a discussion about it yesterday on another event, actually, and there were a lot of comparisons drawn about how the hospitality sector is affecting retirement living, senior living, and how hospitality professionals are actually moving to work into that sector. And these new developments are blending a combination of hospitality skills and traditional care skills. In the short-term rental and apart hotel space, those companies that have been operating with a master lease model have been hit very hard during the pandemic. Stay Alfred, for example, has closed, and others are really having a hard time. Yet there's been a massive amount of investment in the distribution side, Expedia, Airbnb, and so on. So it'd be good to talk about whether what the future of leases might be and how investors will look at those, and also whether the distribution space is attractive. So we have quite a busy agenda to get through, and there's we'll try and do our best. And remember, if you do have any questions as they come through, please do put them in the chat function, and we'll do our best to get around to them. So I'd like to kick off by asking the panel if the COVID crisis has caused you to change your investment strategies, and if so, how? And perhaps Michael, if you could start us off with that one, please.
Yeah, so I think the last few weeks, or probably 2-3 months, have been obviously highly unusual to say the least. So I think there was initially a big focus on making sure that all our employees, colleagues, partners safe and sound. There was also a big focus on the existing portfolio that we have, different platforms, to make sure we position them in a way that they can weather the storm. So big focus obviously on liquidity, cash collections, financings, et cetera, et cetera. And I would say that overall we are in a pretty good shape, because we have, I would say as a firm or fund, have been always very kind of macro focused. So the last 2-3 years we had been already net sellers. We had somehow were a bit paranoid already around the kind of extended cycle and obviously a crisis that would come at some point. Obviously nobody could expect this to come in this form and shape, but we did obviously sell off a few of our positions, and the investments we have made more recently have all been sectors or platforms that on a relative basis are more downturn resilient investments. So we invested a lot across PRS, student housing, continue to invest in industrial, light industrial and logistics. So from that perspective, we are in decent shape. And then I would say the flip side is that we're in a fortunate position that we raised our last fund last year, which is a 3.7 billion fund, of which we have a bit over 80% not invested, so dry powder. And I think from that perspective, as an investor, you're obviously at the market, and I believe we're at the beginning of a major repricing, and think this you know, the next few years ahead of us could be interesting, and could be more interesting vintages to invest in versus the ones leading up to COVID. As we know from the previous cycle or crisis, GFC, it takes a bit of time for opportunities to come through, but we do think that they will come. Now, you know, in terms of strategies, I think most of the strategies we have in place will continue. I think they are generally strategies that are based on secular trends and investments that we like. We will continue to do those, but I do think we will add a few new ones that might be more interesting now than they have been pre-COVID. And to give some examples, I do think, for example, that the hospitality sector could become more interesting going forward, and that's something we have been investing in quite focused through our A&O hostel platforms. It's in the budget space, and that will also give us an opportunity to grow this platform further. But there might be some other opportunities outside of A&O as well that could be interesting. And generally, I would say it will depend a little bit in terms of geography and product, how the recovery looks like, and which sectors have been more, some sectors have been more affected than others. But now is clearly the time to position yourself and see how you can you know, play this market going forward.
Mm-hmm. And Milan, what about at KKR? How has your strategy been affected by the last few months?
Absolutely. So quite similar to what Michael is describing. We are lucky that we are in fundraise and targeting, you know, fund size of 1.2 billion for Western Europe in real estate, of which you know, roughly 90% isn't committed today. So we will have a lot of firepower in the next few years. In terms of our focus, pre-COVID, we were already spending a lot of time on what we call the bed sector, which includes residential, student housing, and hospitality. And I think, you know, our view post-COVID is this sector is going to become even more interesting than it was, for a few reasons. The first one, you know, if you look at residential, it is a sector which is going to be more resilient than some others, you know, given the secular trends. And we also believe that there is going to be more appetite from investors and institutions going forward to refocus part of their portfolio towards this sector, which by nature is very granular today, and where, you know, most of the products in some geography just doesn't exist. And our strategy is actually quite similar to what Michael was describing in terms of creating platforms to access these more granular sectors. And that's where we are going to continue to spend a lot of our time in the next few years. I would say the second thing that we are seeing and which we're focusing on post-COVID is affordability. And in the sectors that we are targeting today, it's really in two different areas. The first one being hostels, where we are going to continue to develop the platform. And we believe that there are going to be opportunities arising from the crisis where there should be consolidation in the sector where, you know, if you look at the hostel sector globally, only 8% of the rooms are branded. And we do believe that COVID is going to force some of the consolidation in this sector. And the second area is going to be probably around the co-living sector. We do believe in communities. We do believe that more people are going to be attracted to live in places where they are not on their own, but also the affordability point is very key to us in the sense that, you know, co-living, we believe, offers a good alternative to offer more affordable living space to a number of people and who are spending time across Europe on that sector.
Great, thanks. I'd like to talk about some of these sectors in more detail as we go on, but Lissa, I know you're frantically working on some deals at the moment. So has the pandemic slowed things down, or is it business as usual, more or less?
Oh, business is busier, I guess, now. Only insofar that we have two hats on, or I wear three hats, I guess. One is obviously the development we have, but the other two is in our underwrites right now, because of the market and because of the difficulty, we are finding that we have to go back in our underwrite with our partners. So the private equity funds that we're working with, they have revisited, obviously the risk is different now on the project. So one good example is a deal that we had, which was going to actually be in a value add fund, has post-COVID now then moved from a 15 levered IR from a value add to an opportunistic. So they've gone up on their risk curve for the same asset, same structure, and therefore we need to go through the underwrite, and the funding market is difficult. So you're not getting more leverage, you're getting higher cost of capital. You have to work it through and see where, other than renegotiating the purchase price, where else can you find some quick wins? So one area now is, given certain markets where many other players are holding off on their developments, you at least have some savings on construction costs where the contractors need to, you know, they've lost several of their projects, and therefore at least you can get some cost savings there. But from development perspective, it's a lot trickier on the deals. And if you're another deal we're looking at on a forward funding basis, you have to actually help them on the funding side as well. So I think you're working through a deal far more, you're running many more scenarios, you have to build in many more contingencies on it. So it's tough on that aspect. On the other side, we are partnered with a PE fund who's looking for, quote, distressed. Thankfully in this market, there is no distress yet. And I'm wearing a hospitality hat in saying that, insofar that you've got lenders and borrowers who are very collaborative. So you're working through interest payments, holidays. You're working through how to restructure your current assets. And so in that way, we're not going to see those prime assets to acquire at the discounts that a PE fund is looking for until Q4, arguably Q1 of next year.
Okay, thanks, Lissa. Florian, what about your perspective from across the pond?
Yeah, as I said, we've been focused on less cyclical assets prior to the crisis. I guess everyone was expecting a correction, obviously not in this shape or form. So both multifamily and other residential investments, as well as logistics, have continued to perform well. We shied away from the coasts and cities like Los Angeles and New York, where affordability is very low. Demographic trends are, at least for the moment, have been reversing as a lot of rent regulation. So we're focused on the gateway cities of Texas, like Dallas, Houston, Austin. Houston is a bit of a special case, given its oil dependency and the recent volatility there. But in general, rent collections and occupancy are doing are really keeping up well. There is a risk of a second wave, which I think is a bit a distinguishing factor from Europe. Infections have been rising, so I think it's probably still too early to tell how this will even pan out in the short term. Industrial is doing very well. We've been shying away from hospitality as well as hospitality and developments as well as commercial, as we perceive them more cyclical. And I think it's too early to tell. There is certainly it certainly depends on where assets are located. If they can cater to local travel is open here. International travel is still very much shut down as elsewhere. Short-term rentals are not doing well, but a lot of them are right now being converted to medium, longer-term rental, which are actually doing rather well because people who can work from home are fleeing from the cities and are working from rented houses or other places. And yeah, co-living, student housing are holding up well here. A lot of students are still locked in their places. Co-living has been performing rather well. A lot of students have been kicked out of their dorms and are renting that. But I think with a lot of these things, we kind of have to see still. So we're still in a holding pattern of watching. But we're not just looking at the pandemic as a kind of medium to long term factor, but we also think that globalization is changing when it comes to in industrial and logistics. What we've seen is that there is certainly a trend to a more national approach, and with travel we have to see the same thing. And as I mentioned before, cities are not really growing anymore. And here also with protests and riots, there is some concern that cities will become less attractive, or major cities will become less attractive in the long term.
Okay, thanks, Florian. Christian, we'll talk a bit more about co-living later, but you mentioned that you've launched a fund for London developments with the Collective. Has what's happened in the pandemic had any effect on your plans with that going forward? Has it slowed things down, or are you sticking to your original schedule?
Yeah, well, I suppose I've got a slightly different perspective to maybe where TPG and KKR are at, because we were having launched the fund at the end of last year, we were sort of just gearing up to start our capital raising. So we fortunately had closed enough equity to get going with doing a few deals, but we were quite early on in talking to investors about coming into the fund. And it's been really interesting, actually. Unsurprisingly, for the first couple of weeks, we sort of all pens down and not many conversations going on. But over the last 3 or 4 weeks, as people have, got to grips with existing portfolios, thinking about, what the next sectors are going to be, we've had an awful lot of engagement with institutional investors who have I guess, kind of, contextualised it. If you look at how residential and multifamily and co-living sectors have fared over the last few weeks, it's proved to be a very defensive sector. Across the co-living assets which the Collective operates, they've been doing about 94% rent collection. Occupancy fell 6-7% pretty quickly, but has stabilised ever since. And when you put that, you contextualise that against retail, office, even industrial, they're very strong rent collection stats. And I don't think that's a co-living specific comment. You look at all the big build-to-rent operators, they're delivering similar statistics. So actually, from our capital raising point of view, I think it probably delays us by a few months, but I think in the medium term, actually, perversely almost a positive. I think I won't be the first person to say, we've all seen hundreds of people say, I think this pandemic has just been an acceleration of trends, hasn't it? And multifamily, co-living, whatever you want to call it, was already something everyone was looking at, but I think everyone's now going to be looking at a lot sooner than they would have done. So it's been quite positive. I think another angle that's sort of grabbing a lot of investors' attention, sort of, and we'll keep saying post-pandemic, but we're obviously not post-pandemic, but is, the co-living allows you to have a sort of very big social impact in the way that you look after tenants' wellness and engage with your tenants and look after them. And I can see that becoming, much more important for investors going forward. So their conversations we've been having a lot about. And I suppose finally, just on the deployment of the capital that we do have, like Lissa said, a lot of opportunities have opened up to us in the last few weeks, which wouldn't have been there. There's not distress in the market yet, but if you're going on development deals, previously 3 or 4 months ago, developers were able to leverage things at 95% and get sources of credit to get themselves to site so they can forward fund things. Now the developers we're talking to have, got a hole in where they can get the capital from to do that. And that's sort of given us a lot of opportunities, which I think we wouldn't, our capital wouldn't have been competitive to fund a few months ago.
Thanks, Christian. If we move on to talk about hotels specifically for a while, I think it's probably fair to say that out of all the hospitality asset classes, hotels have been hit the hardest by the pandemic. We are seeing hotels close. We're seeing hotels go into administration. It's just been announced today that the addition on Times Square is closing after just a year. These are big marquee projects that have been really slammed. Do we think there's going to be a big shopping spree for distressed hotel assets in the next 6 to 8 months? Or, I mean, for the companies that you guys work with, is that a diversion that you don't need, or is there value out there that's too good to ignore? Michael, what are your thoughts on that?
Well, I think not sure if it will be as soon as 6 to 8 months, because I think generally, I think most businesses find a way to manage their kind of liquidity for some time. You can probably go and speak to your bank and get at least a couple of quarters a waiver in a lot of cases, and you might still have some cash reserves from the previous year. So I do think that we will see some distress, but I'm timing wise, I expect it to see the cracks starting beginning of next year. I mean, obviously selectively, I think we'll see something already now, but I think the bigger wave will come next year. I think it will also depend a little bit on the geography. I think there are certain markets where we're going to see less distress than in others, also kind of based on how the economies overall are doing. So, Germany, for example, is kind of relatively dealing with this crisis a bit better than others, and I'm going to come out of this a bit quicker. And then I do think as well, it depends a little bit on the category within hospitality or the type of product that you have, where you have to differentiate as well. I think that the budget space is somewhat, the limited services budget space in that sense is a bit more resilient. That has to do with the actual cost structures that you have, or the cost model. So to give you an example with A&O, at the moment, I think everybody's suffering if you're part of the hospitality sector, but in our case, we have a much leaner cost model. So we, for example, have a break-even occupancy of 30%, which compares with the traditional hotel model, which is probably closer to 60, 65, plus minus, depending obviously on the actual product. Obviously, when travel is put on hold, even 30% hurts because you're below it, but it will generally take us less to get out of this again, and you're a little bit more agile because you don't have this big kind of cost machine that you have to feed throughout those kind of difficult times. So I think it will depend a bit, but I do think as a general matter that there will be some interesting opportunities. You just need to think about how what strategies within the hospitality sector you want to play and why, and see how you have a differentiated angle to obviously execute on those.
Mm-hmm. You mentioned that owners and banks are talking constructively. In your experience, are banks being more flexible with owners now, which then allows owners to be more flexible with operators than they have been in previous recessions?
I think generally banks don't want to have immediately restructuring cases on the table either. So they will look at this in a constructive way and will differentiate between businesses that are fundamentally healthy businesses but are undergoing the same kind of crisis. And I think as a general matter, I do think they're trying to be helpful, but they will also look at it carefully and say, you know, this won't go on forever. This, to my earlier point, they might start it off and say, I'll give you a waiver for a short time and then see how you get on. But at some point you need to be able to get out of this on your own and recover and break even again, because obviously at some point it becomes obviously challenging for a bank as well. But generally I think the approach overall, as we have seen and what we hear from people on the ground, is that banks have been constructive so far as a general matter. Obviously there are differences, but that's at least the sentiment that I'm getting.
And Milan, does that tally with your experience? And is KKR likely to adapt strategy to look at distressed assets as they become available in the next year or so?
To answer the first part of the question around what we see on the banking side, yeah, that's very much in line with what TPG is experiencing. What I would say is for new deals, I think securing financing for hospitality deals in the next few months is going to be more challenging. That's true. And what we are anticipating is a bifurcation in the market between, you know, the stock that basically will thrive in the future in a post-COVID world, and the stock which even pre-COVID was starting to age basically. And both on the financing and investing side, there should be a run towards quality. And I would say there will be a run towards quality of the covenant as well. A number of the institutions which were just looking at, you know, hospitality, like, hey, you have a long lease and you're going to be fine, are realizing that actually the quality of your counterpart is key if you want to sustain both operations but also liquidity in the longer term. So what it means in terms of our strategy going forward is we are going to continue looking at the sector. Agree on the timing. I think we will probably need to wait more than 6 months to see distress. But at the end of the day, of course, we look at interesting situations if there is distress, but also continue to partner with groups where we think that they have the right business model and, you know, they need capital to grow. That's really the DNA of KKR, is really helping groups grow to the next stage of their capacities by providing, you know, capital and internal know-how. And that's what we are starting to do right now in the post-COVID world as well.
Great, thank you. I'd like to talk about some specific asset classes now, starting with service departments, which have performed relatively well over the lockdown period. They've been able to flex the business model and accommodate key workers and maintain reasonable occupancy levels. The ability to offer self-contained units where people can self-isolate has obviously helped there. Is that an asset class that you will be looking at with a renewed focus in the light of what's been happening? Lissa, what are your thoughts on that?
Indeed, we're working on one already, and it was interesting to see the LP interest. So pre-COVID, where we have a dual site, and so it was a dual strategy, and the underwrite for the hotel was very easy. And we had to really discuss the attributes of the service department. Now that has very much shifted now, because they do understand that is, it's a very attractive product. What we've done as well is we have changed the F&B offering. So we've made it more of a grab and go. So I think even those that are developing now or underwriting, you are thinking about what do you need to change? And it's use class optimization of your ground floor. How can you, in essence, it's more hospitality-led mixed use schemes, but even within your quote service department, you are going to look at what changes do you need to do now. But can I just, George, sorry, just on your previous point, on distress and exactly what Michael and Mylan were saying. It's also what we're looking at now is those products that are distressed, or those hotels that are distressed, are the ones that in essence, you know, everybody talks about occupancy level, but that's at the operational level. It's not with financing and with tax. So whilst you're at a mid-30s, early 40s per hot step for even luxury to economy, once you put on your financing, so depending on how the owners have their cap stack and how they finance, you're actually then looking at 60 to 70 occupancy, plus you've got the initial CapEx to reposition that hotel. So the types of products we're seeing, quote, now that are distressed are the one-offs that it's too costly for them to reopen because of their financing structure and therefore because of the need to reposition that asset.
Okay, great. Going back to the service departments, obviously traditionally their core customer base has come from business travel, which is likely to be slow to restart, possibly than leisure travel. Can you see service department projects and operators shifting their focus to attempt to attract more leisure guests who will see the self-contained nature of the product as a bonus? Will that be a route that they'll take for the sort of short to medium term? Lissa, I'll throw that one back to you.
Sorry for the diversion before, but yes, you will see them catering more to the leisure. Now, whilst leisure is going to rebound faster than corporate, arguably, and it was discussed yesterday on the panel, which is those that are coming back on corporate, you're going to have longer stays. So it's going to be more the senior members of firms. They're going to stay, instead of doing a day in, day out trip, you're going to actually stay 2 or 3 days. So yes, you need to cater to, quote, the leisure, but also think through the corporate market, where obviously now think through anything where you don't need the air travel, but think through also the corporate demand Monday through Friday, and how can you also keep those guests for longer. So I think, yes, the product will be tailored, but also you do have that upside that when corporate does rebound, it's going to be for longer stays.
Okay, thank you. Let's move on to co-living for a moment. Christian, you are obviously very immersed in this market. Do you think that the product will have to change as a result of COVID, or is the design and operation of co-living properties not going to be affected too badly? Is what we're experiencing more of a temporary blip?
Yeah, well, actually, I mean, obviously the concept of co-living is a place for people to live. So it's not, whilst we do have a short stay model, and some people come and stay for a night, a week, 2 weeks, you know, the average length of stay is 8 months. Well, actually, that's not true. The average length of stay is 13 months. The average length that people sign up for is 8 months. So we're creating a home for them. And the concept of these buildings is they're, you know, self-contained studio apartments, which are circa 20 square meters. And then we fill the building with communal amenity space, whether that be restaurants, bars, co-working rooms, swimming pools, etc. And I think the important thing to note is in the strategy, we're trying to create an affordable place for people to live. And really the sort of people we're targeting are people that would otherwise be in a flat share. So I think, you know, the initial reaction for some people might be co-living, you know, lots of people living together. Is that what people are going to want to do in the future? And I think if you say, you know, if you were to compare it to going into, I don't know, a grey star 1-bedroom flat where you can put yourself contained, and, you know, you can see how people might draw that conclusion. But the average person that lives in a co-living building, if they didn't live in a co-living building, they'd be in a flat share with 4 or 5 other people they may or may not know, sharing bathrooms, kitchens, all trying to work together around a kitchen table. So for our members, actually during the pandemic, having their own self-contained space has been very good. In terms of how we're thinking about design going forward, we're sort of, you know, we've got 10 schemes across London. We're sort of drawing, you know, we're at the start of developing on, so we've got a lot of thinking to be doing. I think the biggest change for us really is clearly going to be a big movement to people working from home a lot more. And it's just thinking about how we can facilitate that better than we already were. I mean, every building already has a, you know, substantial amount of co-working space in there. But it's sort of going that next level, you know, nobody knows how many people are going to work from home, but it's certainly going to be more, isn't it? So that's really the area that we focus on so far in terms of change of design.
While we're on the subject, I can see a question from Steve Lowy in the chat there. He's asking, has usage of the public areas in co-living and hostels fallen since COVID? Saying that this is key to the vibe of both hostels, co-living and co-working. Is that something you've experienced?
Yeah, so we've managed to keep the vast majority of the communal spaces open. We shut some, the gyms shut, the swimming pools shut, obviously the restaurants, etc., bars had to shut. But the vast majority of space we've managed to keep open through, social distancing, putting markings down in buildings, putting signage up, extra cleaning rotors, etc. So on that side, it's been okay. The other big element of our version of co-living is the events program. So every single day in these buildings, we have 3, 4, 5, 6 events put on, which are all sorts of random things, from yoga in the morning, cooking classes, learn to code, learn to speak a new language. It can be anything. So that events program's all moved to going online. And interestingly, maybe it's because people have more time on their hands, we've actually had, so we have about 75% of our members that are doing more than 5 events a week now, which is higher than it was when you had to turn up physically and attend the events. Now, I don't think that changes our view. I mean, the whole point of co-living is to get people living together in a connected community and trying to tackle lots of issues around loneliness and lack of communities in big cities. So I don't think that's something we'd want to carry on doing going forward. But the community have been able to adapt very quickly.
Thanks, Christian. Mylan, can you tell us a little bit about your plans for co-living?
Of course, we are exploring a number of co-living opportunities in Europe right now. Too early to disclose names as we are still working on these, but we do believe that people will want to live in these schemes, and especially on the affordable end, as we discussed earlier. The issue with co-living is it regroups a large number of realities and concepts. I think where we feel more comfortable is around the places where effectively you can offer a consolidated, space to live, work with everything included at a cost that would be in line or below what you would have to pay if you are basically looking for accommodation on your own. In terms of the locations, we are focusing on city centers in key gateway cities. We are, for now, shying away from the larger schemes, which are in slightly more, I would say, B2C locations, and talking with a couple of operators. Given our DNA, the way we're approaching the sector is both from the real estate side, but also talking with operators with a view to take a stake both in operations and real estate.
Great, thank you. Let's move on to hostels briefly. I guess it's fair to say hostels are a fairly recent institutional asset class. There haven't been that many large branded operators in the space. Michael, you're involved with A&O, one of the leading hostel brands. Is this an area where investment focus is going to increase? Is this the time for hostels to kind of have their moment in the sun in the investment community? And what are your plans for the rollout of the A&O brand?
Yeah, so maybe just to put a bit into context, we invested in A&O probably now 3.5 years ago. When we bought the business, it was mainly a German-centric platform. So 25 out of the 30 assets were in Germany and kind of Austria. We've now turned it into a European platform. We're now in 9 countries, including pipeline, roughly 30,000 units. So it's become a significantly larger business now. And after a few of the kind of key initiatives that we did up front, where we positioned the design and brand, expanded basically the footprint, focused more on kind of also FITs. Historically, we have been kind of more focused just on groups, so we now have a combination of both. We have also observed that this sector has become more and more institutional compared to when we started looking at it beginning of 2014. It took us 2 years to close that transaction in beginning of 17, but we have been observing the sector now since beginning of 2014. Obviously now with post-COVID, there are a few question marks around the business model as well, how all of this will affect the hostel model overall. It's impossible to predict. What I would say is that based on the data we've seen so far, our recovery already has been faster than probably most other kind of hotel businesses. A little bit kind of related to the point I was making earlier with a leaner cost model, but also generally focused on kind of younger cohorts. So we're mainly focused on millennials and Gen Z cohorts that have been probably on a relative basis also less affected by this crisis, and generally are I think more willing to kind of move on and start traveling again. As we observe the recovery, we do think that we will see a recovery in the kind of domestic FIT travel first. So it will take longer for groups to come back next year. But as we see the different economies across Europe opening up, we've already seen very, very strong kind of pickups and spikes the moment people are allowed to travel. And this is obviously something we'll continue to observe. I think overall, I still believe this is a very attractive business model. It's becoming more institutional, and the budget space just has proven, I think, that it's a kind of more downturn resilient business model, which is something that investors value as they invest across different cycles. And therefore, we certainly intend to continue growing this platform, and I think there will be some interesting opportunities to do so.
Do you think the physical product will start to more closely resemble perhaps a design-led economy hotel with fewer dorms and fewer beds in the dorm, or do you think that the dormitory element is going to be as attractive as ever?
It is, but I would say it has already changed, right? So if you look at the hostel model today, which I would call the 2.0 version, it's no longer focused on what people maybe associated in the past with a hostel, which was a simple, just backpacker, dirty, filthy, kind of bunk bed, pure bunk bed in that sense model. These days, it is very much driven by FITs and design-led. Design these days doesn't cost that much more. So if you have somebody that has a bit of a sense around kind of color schemes, lighting, creating a bit of atmosphere, that's what you're focused on. And again, the younger people or the cohorts that we're focused on, for them, it's all about the experience. So they value experience higher than material things. So what you're trying to create is an environment where people can connect. They spend very little time in the rooms anyway, so they spend more time exploring the city, or they like to connect in the common space with other travelers. And that has been the focus when we thought through a design and brand repositioning to cater to that kind of customer. And as we were thinking about broadening our customer base from not just groups to kind of more FITs, because that's obviously the group who can yield better. These have been all kind of aspects that flow into the overall concept in that sense.
Okay, thanks, Michael. I'm going to start taking some questions from attendees now. We have one from Jan Gard here. Thanks, Jan. He said he listened to the CEO of Vodafone yesterday saying that they won't have more than 20% of their current office space post-COVID. Which asset class do you see best positioned to take up some of the slack of that unused office space? Florian, what would be your thoughts on that, please?
An interesting question. I mean, floor plates in general, office don't lend themselves to easy conversions. So, hard to see. I think we're right now a little bit at a shock where people enjoy working from home, and it's certainly accelerated its acceptance. But I think efficiency is still higher working in offices, and I think a lot of people are also happy to go back and work from an office. And I think in the long term, it will probably be more balanced than it looks right now. but certainly, I mean, there are other things like obviously WeWork have been a big driver of office demand in the last few years, which have now decided. So I think, yeah, some will probably, it depends a little bit where it's located. Some, we looked at student housing conversions, for instance, or hotel conversions, where you have to, do some structural work to create light walls to be able to cater to living. And, maybe, some spaces can be converted to last mile logistics, something we're looking at. But again, I'm not, I'm probably not as optimistic as thinking that we will, or I don't think everyone will go back to 20% of their office space to be eliminated.
Okay, thanks, Florian. Christian, the collective, I believe up to now has all been new build properties, but could you see the potential to convert office space into a collective development?
Yeah, I mean, so far we've focused entirely on ground up development because the products, the whole essence of what we're trying to do is provide a much better quality accommodation, a different way of living, and it's much easier clearly to do that. You can start with a blank piece of paper and design the buildings to be efficient in terms of the way people live in them and operationally efficient. I'm not I mean, I share Florian's view that I don't think that 80% of office space will become redundant. So I'm not sure there'll be that huge opportunity. More where we've been looking is, I think there could be some distress in the student accommodation market. There clearly could be some distress in the hotel market. And all of these bed sectors, you're talking about, 18 to 30 square metre boxes, which are occupied for shorter or longer amounts of time, but over their life cycle can be operated, as co-living student hotels. And one of the things we've always really liked about the sector is that when you're underwriting a co-living deal, you can always underwrite its alternative use as a student accommodation block, as a hotel, with very little physical change. The building, there'll be a rebrand if someone else came in. But I can't really think of another sector where you could say, let's say for some unknown event like this one happens in the future and co-living turns into a disaster, overnight it could turn into a hotel building, a student accommodation building. The office sector, clearly retail's got big problems around that. So that's one of the reasons we really like the sector.
Okay, thanks. Would the costs of converting office buildings, say in central London, into a hospitality use be higher or lower than starting a new build project from scratch? I don't, who wants to, Lissa, would you be able to pick that one up?
Generally, it will be high because of all the structural changes and exactly as Christian was saying previously, it's easier to do a new build. But it depends. It depends the office, it depends the depth of it. I saw that our architects are on this call here, but depends the core, the structure of it, because obviously you've got to see how you've got the rooms and the corridors. We posed the same query last week on one of the cross-sector panels, and it was wonderful to see. There's going to be more collaboration between the use classes. So it could be a hospitality-led scheme, but you'll have some co-live, some co-work, some retail, and then the hospitality side of it, whether it's service apartment or hotel. But therefore, I think everybody's going to look at use optimization of the site.
Great, thank you. So before I just take you all through a few concluding slides, I've just got one more question here, which I'll put to you each in turn. And if you could just give me your answers very quickly. It's from David King of Vivid Hospitality Solutions. And he asks, which of the following best describes what COVID-19 has done to the appetite for future investment in the hospitality sector overall? And your, your options are A, reduced it, B, not changed it, C, increased it, or D, delayed but not reduced it. So let's go from left to right. Michael, what's your take on that?
Increased it.
Okay, Florian?
I'd say delayed and then increased.
Okay, Christian?
I will be delayed and increased as well.
Lissa?
delayed, increased, and looking finally at the operational asset itself and not just a triple net lease. So making people more astute in their investments.
And finally, Milan.
Increased as well. And Marita, I'm going to need to drop at 3 p.m. So I will be leaving you.
Okay, well, we'll be wrapping up shortly. Thanks, guys, for all your input. Justin, if you could just roll on. So next week, we have a really fascinating subject for our next webinar, work-spitality. I'm not quite sure who coined that phrase, but it's fairly self-explanatory. My colleague, Piers Brown, will be chairing that one. We've got a great panel. We've got Stefan Benzimon, who's the president of Wojo, which is Accor's co-working brand, and some Debbie Wasco from Albright, David Kaiser from WeWork, and Matt Watts from Labs. So that's same time next Wednesday. So don't miss that. It should be great. And as I mentioned earlier, these webinar series are a precursor to the Urban Living Festival. Please do have a quick look at the website, urbanlivingfestival.com. It's going to be a fantastic event. It's themed around 3 stages called Stay, Live and Work. We really think it's going to be unlike any conference you've ever been to. We're very excited about it. These are some of the people who are on board already as sponsors, so thank you to them. I've also seen some of our supporting partners are on the call today from Questex and Skiff and the like, who are partnering with the event. So good to see you guys. If you're interested in sponsorship, please contact my colleague Katie, whose details are there. This is the series of webinars, the next few coming up. So make sure you'll be on those. All of these sessions are recorded. So everyone who's registered for this session, and we had over 400 people registered from the investment, development, operator and supplier community. So thanks to you all. You'll all get an email with a link to a recording of the event. So don't forget work-spitality next week. Thank you very much, Michael, Florian, Christian, Lissa and Milan. And hope to see you all on a future webinar. Thanks very much.
Thank you.
Thank you, everyone.
Thank you. Thanks. Bye-bye.
Bye.
Bye-bye.